Hello and welcome to CommBank View Economics and Markets, a brand new podcast from CommBank where we tackle one big issue each week that pertain to the markets and economies. My name is Mandy Drury and I'm absolutely delighted to be your host alongside all the CommBank expert voices, economists and strategists. So the proverbial inflation genie is out of the bottle again, and this genie is very stubborn and not wanting to be stuffed back in. What does this mean for the Australian economy, especially as now we're throwing into the mix the inflationary forces coming out of the ongoing war in Iran? I'm very happy today to be joined by Belinda Allen, Head of Australian Economics. Belinda, hello.
Hi Mandy, great to be here.
Great to have you. Tell us how inflation has become such a problem again for Australia.
It was only around 12 months ago that we'd effectively declared victory on inflation. The RBA was cutting the cash rate again, inflation was coming back down to target. Then all of a sudden, the second half of last year, inflation started re-accelerating. And the short answer is we are growing too fast for how much capacity or supply there is in the Australian economy. So we've heard, I think, the buzzword of the Australian economy the last 6 months also has been the speed limit. Mm-hmm. How fast can the Australian economy grow without generating inflation? And the answer is the speed limit is below where we're currently growing, and that's why we've seen inflation surge. And it is actually very broad-based. When you look at what is driving inflation, there's no one single reason. It is around 50% of the basket that prices are rising more than 3%. It's goods, it's services, it's housing. It's very broad-based, and it really comes down to the fact that we are growing too fast and we just don't have as much supply in the Australian economy anymore, and that's for a number of reasons.
So when you say that Australia is hitting its speed limit, who's to blame for that? Is it mainly the consumer or is it the government, or a mix of both?
I think it's a mix of everything. So there's two reasons for that. The first is demand is too strong, and that's a combination of consumers and what we saw over the second half of 2025 is households really lifted their spending. They took advantage of improvements in household income growth, lower interest rates, lower inflation, lower taxes, and they grew in confidence and started spending on a whole range of goods and services. At the same time, we saw public sector spending remain very resilient, and we also had business investment grow as data centres started to really become a big investment decision of choice. So that's kind of the demand side of the equation. And then we have to look at supply. So when we think about what supply there is in an economy, we think about how many people there are, how many people are working, and also what we call productivity. So how much are we getting out of all that investment and people in the Australian economy? And it's really that part, the supply side, that hasn't been able to keep pace with stronger demand. So in short, there's no one thing to blame. It's just been a series of strong demand and weak supply that's driven this inflation higher.
But now we've seen a fuel price spike, and we also don't know how long that will last for. And I would also maybe say that even after there is a ceasefire or an end to the war in Iran, because of the damage that's been done to energy infrastructure, it could linger on for some time. Will that spike mean that consumers start to tuck in their heads? Because this sort of slithers along the economy like a snake, doesn't it? Because it affects the food prices that we pay, the product prices, everything that goes on ships, in planes and on trucks.
That's right. And I think that is the concern now. And what we're already seeing from a number of businesses is them saying they will need to raise their prices. And it's still, I think, this hangover from the pandemic where we saw a lot of businesses have to wear higher costs themselves because demand was weaker. We've had this stronger demand environment, so businesses have generally passed on higher costs, but now they're faced another round of price shocks. So we will, in our view, start to see not only these energy price shocks impact inflation, but more and more we are starting to see businesses talk about passing on higher costs. So they can only do that if the demand environment's strong. So that comes back to your question is, well, what will consumers do? Now, we can look at our CommBank data the first couple of weeks of March, and it's remained resilient so far. Now, we generally were already anticipating the consumer to slow into 2026. We've had 2 interest rate hikes. We did expect to see some moderation in income come through. Inflation was a little bit stickier. So already household spending was going to soften from those very strong rates we saw over last year. I think the biggest question is, well, how much? And that's where it comes down to not only what income's doing, what wealth's doing, but that sentiment channel. And that's the hardest thing to predict. So we do think household spending will slow. But what I would say is we could see a bit more resilience because we know households are going into this more challenging environment with a high savings rate, good buffers, and we do know a lot of mortgage holders didn't lower their repayments through those interest rate cuts last year. So we do think spending will slow. The exact size of that slowdown, though, I think is subject really to the confidence, and that's what's harder to predict.
So you've really hit the nail on the head here when you talk about the fact that, we've seen 2 consecutive interest rate rises from the RBA. So for anyone who's affected by borrowing costs now that they're going up, it's adding insult to injury because the RBA was already hiking before Iran.
And they were hiking because of those domestic economic conditions that we spoke about. So if you think about it, the RBA raised the cash rate in early February before this conflict took place. And the real reason is between August, when they last cut the cash rate in 2025, and February, all of a sudden the RBA had realised that this speed limit was low. We were already breaching our speed limit and inflation was re-accelerating. So we were at a very different point to our economic cycle compared to markets offshore. But you're right, interest rates are already rising, and it's because the RBA did not want to fight inflation again. And now adding to that, we have rising energy prices. As you say, it goes through other prices in the economy. And the RBA don't want inflation expectations to rise. So they've gone back to back. We know that March decision was very much line ball, given the uncertainty. But as I said, for them, the fundamental reason is the domestic economy was running too strong. Our speed limit was lower and inflation was already rising. So it does add some challenges to the household sector this year.
I don't know whether, Belinda, you've been recently in the supermarket buying any chips or chocolate, but shrinkflation is now alive and well. Let me come back to monetary policy, though, because it's such a blunt instrument, isn't it? Are there any other mechanisms to be able to fight this inflation?
It's a good question. And I think that's what, when you hear from the Reserve Bank governor, it is they have one tool. So that's a tool they have to use. And it is generally effective. We have seen in past cycles with interest rates moving higher or moving lower, it has worked to either boost growth or slow growth and get inflation back to target. There is fiscal policy though. Mm-hmm. We are now 7 weeks to the federal budget. We do know leading into this, with that higher inflation environment, there was very much talk of having a fiscally constrained budget to help inflation come back down. And it's fair to say, with a global conflict, rising energy prices, challenges for the household sector, what the government does now, I think will be very important in where the risks for inflation go from here.
To date, though, Belinda, I'm putting you on the spot a little bit here, but do you feel that to a certain degree the government and fiscal policy has been working at odds with the goals of monetary policy in the RBA?
I think there's 2 different ways to think about this. Certainly, the government has still been spending in the economy. So if you look at what we've seen on aged care, the NDIS, just recurrent government spending, that has remained really solid. Could they have spent more of the windfall of stronger revenue growth? Yes. So they could have spent more, but they're still supporting economic growth and they're still adding to aggregate demand. And as you know, we've talked about all through this podcast, it's the fact that demand is running above supply at the moment that's creating inflation.
Let's delve into the Iran impact in more detail, and we'll play a game here where we're picking 3 boxes and each box has a very different war outcome. So you need to tell me what it means for the man out there on the street, the woman out there on the street, the person out there on the street, and the Australian economy. So number one is, box one is a sudden withdrawal by the US or a ceasefire of sorts. Therefore, things settle down, commodity prices settle down, things go back to so-called normal.
So we've kind of seen an example of that early this week where President Trump did say Iran's come to the table, we're going to start to negotiate, we won't go after their energy infrastructure anymore for 5 days, and automatically we saw the oil price fall. So kind of at the time of recording, it's around US $100. So not quite where we were before the war. So we definitely have seen an impact in petrol, but it would come back down. And I think really the impact on the economy is through uncertainty, whether or not a ceasefire is going to hold up. We've had 2 back-to-back interest rate hikes, so you would still expect the Australian economy to slow a little bit and inflation to rise. But that is a more benign scenario than I'm sure what you're going to ask me for the next one.
Behind box number 2 is a drawn-out conflict, but with some resumption of the flow of goods and fuel through the Hormuz Strait.
So I know Vivek Dar, who was on the podcast last week, kind of maybe puts that middle scenario with an oil price of around 120. So that is significantly above where we are now and where we were prior to the outbreak of the conflict in Iran. And it's safe to say that's going to have a bigger drag on the Australian economy. So maybe putting some numbers on this, the Australian economy currently is growing at 2.6% through the year. Those are the numbers for December. Prior to the conflict, we had already been expecting the Australian economy to slow to about 2% by the end of this year. So higher oil prices, some supply chain constraints, uncertainty, you would see that growth a bit lower than that 1.9% with an additional rate hike by the RBA. And headline inflation will be getting well above 4%. And certainly those are the numbers that we're hearing out there in the market at the moment. So that is looking, given we think this is a months-long conflict, not a weeks-long conflict, more of a base case scenario for the Australian economy.
And unpacking box number 3, and I'm scared to look inside, but this is where naturally we see a complete blockage, a continued blockage of the Strait of Hormuz and a drawn-out conflict. As you say, your prediction is months, not weeks.
And that oil price, could look something closer to $150. And that's obviously a very worst case outcome, not only for the Australian economy, but the broad global economy as well. So that would have a much more significant impact on the Australian economy. You could see growth effectively halve from here. Headline inflation will be getting well above 5%. And that will really create some challenges, not only for the RBA, but how do they tackle those higher inflation pressures, because you will also see a slowdown in growth. But what's the fiscal policy response to all of this? So I think the policy choices there get really interesting. I would say, though, it's not all negative for the Australian economy. We obviously export gas and other energy, so we will see some benefits come through to our terms of trade, extra government revenue, extra company profits, but not meaning it's a positive economic impact. And I think a lot of the impact on the economy will then be, how does the government choose to spend that extra revenue? How much do they buffer what's happening to the household sector?
What ducks would need to line up for you to change your call in that May rate hike from just 25 to 50 basis points?
Oh, that's a big call. So I think the RBA would have to be so much more worried about inflation and not worried about growth. And I think that's a hard situation to see shift, particularly because we know in the March rate hike decision, it was a 5-4 split. 4 board members didn't even vote for a rate hike. They thought rates would need to move higher, but I just think you would have to see all the focus on inflation in the near term and less worry about growth. Now, at the moment, the RBA can be worried purely about inflation because the labour market's in a really good position. The unemployment rate remains low. It did bounce a little bit last month, but it's still at 4.3%. So they can focus fully on inflation at the moment. When that unemployment rate starts to tick up, and it will if growth slows, I think that's where the choices for policymakers get a lot more interesting.
I think this is such an interesting conundrum because when you look around you, when you read the headlines in newspapers, Australian companies are currently experiencing one of the largest waves of insolvencies that we've seen in over a decade. And we can really pinpoint particular sectors that are suffering, like hospitality, retail and construction. And then if you also throw into the mix the AI-related thousands of layoffs that are currently ongoing here and abroad. So how is it that the unemployment rate isn't higher? How is it that the unemployment rate is lower than your expectations?
It's really interesting when you kind of dive into the details. We've had, over the past 5 years, really solid growth in what we call the non-market sector. So that's just education, public administration and healthcare. So we know that we have been really big employers over the past 5 years and remain so. Whereas it's the market sector, so all those sectors that you spoke about, jobs growth there was soft for some time, but that's also coming back as the economy's been improving as well. So we've seen jobs growth really quite broad-based over the past year or so. The question is, when you start to go through an economic slowdown, that's where it gets more challenging to create jobs for the people who want to work. And generally what we see when cost of living pressures escalate, more people want to work. They want to work more hours, they want to get a job to help cover those increasing costs. And that's when it gets harder to create the number of jobs for the people who want to work, and the unemployment rate can lift.
So do you think the labour market will stay relatively stable over the course of this year?
We do think the unemployment rate will lift from these very low levels. So, our current forecasts are getting it closer to around 4.5% by year end. But if you start to talk about the two scenarios where the oil price jumps and growth slows, there are upside risks to that forecast as well.
When you talk about how the inflation fighting central bank, the RBA right now, is obviously focused on that side of its mandate, and that at some point maybe it will have to start focusing on the growth side and the labour market side of the mandate. When do you think that scale could be tipped?
I think it gets tipped when the unemployment rate lifts above what we call the NAIRU. Now, you've probably heard of this, but some of our listeners may not have heard about this. It's about the natural rate of unemployment before inflation starts to take off. So our estimates is that level of the unemployment rate is around 4.5, 4.6%. So it's about that level, if not higher. That's when the Reserve Bank, I think, starts to get a little bit more swung between their two mandates.
I know that you've also been doing a lot of research on what's happening out there in the housing market around Australia. And housing does often also constitute the largest source of household wealth. So there is that wealth effect when those house prices are rising. And it could go the other way. It could be the complete opposite of that when you get the negative wealth effect when house prices are dropping. And it really does have quite an impact, doesn't it, on consumer behaviour. What are you seeing right now, Belinda, in terms of what house prices are doing and how that's impacting consumer behaviour?
So we have seen home prices, particularly in 2024, lift quite strongly. They rose by 8%. Big divergences between the capital cities. So your mid-sized capitals, Perth, Brisbane, Adelaide, completely outperformed Sydney and Melbourne. So Melbourne home prices are the weakest across the country. That's generally continued into 2026. So we can look at daily home price data. That might be a little bit too intense for some people, but we do think daily home price data really reflects sentiment out there in the market. And what we've seen so far, particularly in March, since that second rate hike, is we have seen some momentum come off, particularly in Sydney. Melbourne is falling, and I think that is really, as you say, probably the best measure about how we're going to see households react to higher interest rates, higher inflation. And we do generally see wealth and income are the two biggest drivers of household consumption. So if wealth falls and income falls, that's when you start to see a slowdown. But as I said, our weekly card spend data has been quite resilient in March so far. We're seeing the lift in transport costs come through, but we're still generally seeing quite resilient spending across the board.
But are people also relying more on those credit cards and therefore potentially building up more credit card debt?
Well, that's where that's hard to see the switch between credit cards and other spending. But at the moment, it does look like the household sector is relatively resilient. The longer this goes on, though, I think that's where we should start to see some moderation come through. And we do need it to get inflation, as you said, back into the bottle.
If we do get that extra hike in May, and who knows after that, what kind of impact would you expect to see on the home price data?
So we've done a lot of modelling in our team about the impacts of different policies on the housing market. So be that interest rates, be that population, be that potential changes to the capital gains tax. And Trent Saunders in my team has really driven a lot of that work. But generally, an additional interest rate hike will knock around 1 percentage point off annual home price growth.
We only have a couple of minutes left, so let me look at the best case scenario for the Australian economy and the worst case scenario. What would you say is the potential for the upside surprise that you see out there?
I think the upside surprise is households are resilient. So as I said, we've gone into these more challenging times with households having a savings rate that's close to 7%. We know based on data here at CommBank, only around 13 to 15% of customers lowered their repayments last year. So consumers, in a way, smooth their way through this. So they dip into those savings to keep spending, and we know spending is more than half of the Australian economy. So I think that's the best case, together with continued investment in renewable energy, data centres, which is less sensitive to interest rates. That's my best case scenario.
Mm-hmm. And the downside?
I think the downsides are uncertainty. So when we do see, given heightened uncertainty, particularly from offshore, concerns again around supply chain disruptions, shortages of particular goods. I mean, we're already seeing that with petrol, but, food, other manufactured goods, that consumers really do go back to shut up shop. And that's when we see more of a material slowdown to the Australian economy. So really, it's you and me and our choices. I think that's going to drive the reaction to the Australian economy.
The Disney chairman and also ex-CEO of Morgan Stanley, Aussie James Gorman, said this week that the global economy is near peak uncertainty. Would you also say that for the Aussie economy? We're near peak uncertainty? Because you could say there's uncertainty at any given time, but is there a particularly large motherlode of uncertainty right now?
I think we've seen over the past, 5 to 10 years, particularly during the pandemic, rolling uncertainty. So in a way, maybe we're getting a little bit better at dealing with this, but I think the shocks at the moment are coming from a number of fronts, not only the conflict in the Middle East, but policy making, particularly out of the US, policy making here, uncertainty about what the Reserve Bank's going to do, what the federal government's going to do. I wouldn't say we're at peak uncertainty because we've gone into this, the Australian economy, in a really decent position. Growth was at 2.6%. The unemployment rate was low. We have a lot of flex in terms of policy from interest rates. Government debt here is low comparing to offshore. So in a way, Australia's in a much better position to deal with that and to deal with ongoing uncertainty, because we know uncertainty is going to be a real feature of the global economy over the next, 5 to 10 years. We're entering a new era, as our chief economist, Luke Yeaman, would say, on a number of fronts, be it AI, geopolitics, an ageing population, the energy transition. It's kind of this new era that we're facing. So this will just be something where we're going to have to, I think a lot more about, and how it impacts the economy, how it impacts decision making going forward.
Well, thank you so much today, Belinda, for unpacking all of that uncertainty and hopefully some certainty out there eventually as well. Before we let you go, let's get to Lucinda Jerrigan, who's here to tell us what lies ahead in the markets. Lulu, great to see you. And thanks for stepping by. And I feel a little bit like Groundhog Day, and I'm just repeating myself because the first thing I think that we're going to be watching in the markets is the war in the Middle East.
Yeah, that's exactly right, Mandy. So the first thing everyone's going to be focused on is that war in Iran. This remains very fluid. For markets, the key focus is the Strait of Hormuz and whether shipments resume in any meaningful way. So oil prices have already lifted to a high of around $112 a barrel. They're back down to around 110. But there's a clear risk, if the war is prolonged, as we think it will be, that prices rise even further. And this is really the key question. How long does the conflict last? Because the longer it drags on, the bigger the hit to global growth and the messier the inflation story. There's so much uncertainty around this though. So in fact, no market economists have yet downgraded their global growth forecasts. Our sense is that markets are actually currently underestimating the full impact of the conflict, and we wouldn't be surprised to see a greater reaction from here.
And of course, today is the latest read on what's happening on the inflation front in the form of CPI here in Australia.
Yeah, that's exactly right. We'll get an update on consumer prices for February this morning. Importantly, the data predates the latest escalation in the Middle East, so we won't get that impact of that oil price shock, but it will provide an indication of how inflation was tracking immediately beforehand. So we expect headline inflation rose 0.2% in February, with the annual rate easing to 3.7%. The policy-relevant trim mean measure is forecast to rise 0.3%, with the annual rate edging down to 3.3%. So the headline figures may look a touch softer, but under the bonnet, inflationary pressures remain quite firm. And I think it's an important reminder that Australia is entering the supply shock from a position where the economy is doing quite well. Demand is strong, but there's limited spare capacity, so inflation remains a concern. And this helps explain why the RBA lifted the cash rate last week, while many other central banks remained on hold. Australia simply isn't in the same position as other economies. Other central banks have the capacity to wait and see what happens offshore.
Outside of geopolitics, what else is happening around the globe this week that could move the markets?
So it's a pretty light economic calendar offshore this week. UK CPI is probably the main release of note. It will provide an inflation check-in, but as with the Australian figures, it won't capture that recent oil price shock from the Middle East. All in all, markets are very much in a wait-and-see mode as the geopolitical events unfold, so keep an eye on the Strait of Hormuz.
We most certainly are. Thank you so much for joining us today, Lulu.
Thanks, Mandy.
And thank you for joining us today. We do hope that you've enjoyed today's episode. Join us, of course, every single week here on CommBank View, where we talk about what's been shifting out there, the markets and economies here and abroad. My name is Mandy Drury. See you next week.